Monday, April 28th, 2025, Maneco 64, home of alternative economics and contrarian views. Well, today we're going to look at the reset. The reset in terms of the credit cycle. And I'm going to give you my opinion on when it's going to be complete and when the next credit boom will originate from. It's not going to probably pick up right away. It's going to be decades in the making. So we're going to look at the Dow Gold ratio, and we've looked at this many times. And why the Dow Gold ratio? Well, because the Dow Jones Industrial Average represents, really is a benchmark, and it has been for over 100, about over 130 years or so, of the financial world, of the world of investment. And gold, of course, is the ultimate store of value or wealth. It is real money, after all. It was the J.P. Morgan who said in Congress under oath, I think in 1912 or 13, when asked what gold was, he said, well, gold is money. Everything else is credit. So what better way to measure credit than measuring the Dow in terms of gold? And that's why we look at the Dow Gold ratio. And thankfully, we can go back over 100 years here to look at that ratio. And we're going to start with the credit boom that we saw after World War I. It started pretty much, let's say, it actually started with the outbreak of the war in 1914, as you can see here. That ratio was around 2.5. Yes, it came back down in 1921. There was a short-lived depression that didn't last very long. Why didn't that depression last very long? Well, because the government and the Fed hadn't learned about interfering in the markets. So the markets cleansed the excesses of the previous credit bubble from the start of World War I. But you notice that that correction didn't go back to the low from World War I. So it's still part of the same World War I bubble. And then you had the Roaring '20s, of course, and that was the biggest credit bubble up until then, of course, as the Dow Gold ratio went to almost 20-1, as you can see here, is about 19. It might have been higher on a daily or weekly basis. This is a monthly chart. And back then, of course, gold was money. So that means that the Dow almost got up to like 400. The ounce of gold was $20.67. If you multiply that by 19, you get to just under 400. But then, of course, we had the stock market crash of 1929, and that pricked the credit bubble. Didn't necessarily cause it, and who knows why it happened. Well, I think it happened because credit bubbles and excesses don't last forever. Just like if you go out to a party and you drink a lot, there's going to be a point where you either stop or you pass out. And that's the same thing with the credit cycle. And then we had, of course, the Great Depression. It was really vicious. Again, they tried to intervene, actually, contrary to popular opinion. Herbert Hoover did intervene a lot. The U.S. government bailed out a lot of institutions. They borrowed a lot, and the Fed started helping, actually, even though it wasn't supposed to. They weren't supposed to buy government bonds, but retroactively in 1935 they changed the rules or the law. But be as it may, as the Dow collapsed, yeah, this ratio dropped. And back then, of course, it was just a normal Dow. People didn't look at the Dow gold ratio because up until March 1933, which was when coincidentally this ratio bottomed, gold was money, so there's no such thing as Dow gold ratio. There's just the price of the Dow. But yeah, it bottomed at around 2. I've got here, let's see, the exact low from March. Yeah, actually it says 1.9, so just below 2. So that means that, yeah, the Dow was worth about 40 after being worth almost 400. So it was a vicious correction. And that was the first reset, 1933. Remember that date. And then up until, well, February 1966, excuse me, there was a credit boom. Things picked up again. Yes, you had the war in between. You had the New Deal and everything else. But then it topped. And this time it topped higher. It topped, yeah, around 28. Why did it top higher? What's my opinion? Well, because in 1933, the U.S. went off a domestic gold standard. Yes, it was still in an international gold standard. Most of this credit boom from 33 to 66. So there wasn't as much of an anchor. So the credit bubble or credit boom was able to inflate more than the previous one. But then again, things, yeah, don't last forever. And we saw the credit bubble unwind from 1966 to 1980. So it took quite a long time. It took, 14 years. The previous one had unwound in about 4 years. So they're taking longer to unwind as well because it's taken longer to inflate them. So it's just natural. And this time in 1980, we saw, this was January 1980, the low was 0.99 here according to this chart. So I think gold was around 850 and the Dow was about 850. And again, that led to the credit bubble or credit boom that we've been under since. The top really was in 1999 here. And I'll give you the exact number, almost 45, 44.93. That was August of 99 at the height of the dot-com bubble, stock market bubble. And you could argue that we've been in, it's been unwinding since then. But the thing that's happened since 1999 is that we've had the central banks experiment with QE, money printing, like they never have done before. And that's why in 2008, when we dropped to around 6 in this ratio, that's why it rebounded. They've been able to keep this credit bubble going for a few more years. And as you can see, it topped actually in October of 2018. So that's why it's good to look at things in terms of gold. We haven't really been in a bull market in financial assets since 1999, I would argue. And yes, it's taken longer because governments and central banks have become much more activist. But I think, as you can see here by this chart, things are unraveling now. And you might think, well, this is going to take a lot of years. How can the Dow gold ratio go back down to, let's say, 2 to 1 or 1 to 1 or even less than 1? You could have a scenario where you could buy one Dow Jones Industrial Average or half an ounce. And I think that's possible because, as you've seen here, you've had higher highs and lower lows in this ratio, and it looks like a megaphone as well, which is quite bearish. So what about the timing? Well, sometimes the simplest things are the best, as they say. So if you measure 1933 to 1980, that's like 47 years, and you add 47 years to 1980, you get 2027. So I don't think there's much time left for people to protect their credit investments, stocks and bonds. And how do you do that? Well, you have a little bit of gold, or you have a lot of gold. It depends. Or you have no gold if you're fine with having your wealth decimated in terms of purchasing power. That's up to you. But I would add a little caveat to this, is that I've watched Bert Doman, who was around in the late 70s and the 1980 bull market in gold. And back then he said in 1980, when everyone was very bullish and the crowd and the public was getting involved, he said, well, we're now in a bear market and it's going to last until, well, 20 years, 2000. And that's exactly what happened. And then he said back in 1980 that after the year 2000, there would be a 31-year bull market in gold. So you add 2000 to 31, you get 2031. And that's why I think, it might be a little later than 2027. Cycles, like nature, are not always perfect. They are fairly exact, but like this week here in the UK, we're going to get summer temperatures, even though it's still spring. That's what I'm trying to say. So, yeah, be prepared. And if we do get to 1-to-1 or even less than 1-to-1, and it's 2027, I would say that could be the top for gold. But this time around, I think gold will become money again. So you won't really sell gold. You will exchange it for assets. That's the way I see it. Or we could see it going 1-to-1 by 2027. And then by 2031, it could be at 1/2-to-1. So that's the bigger picture there. I really think, having done technical analysis all my working life and fundamental analysis, I think this chart is breaking down, and we're going to see gold outperform the Dow. At what level will the Dow and gold be when it's 1-to-1? I don't know. It doesn't really matter. It's all relative. It could be 100,000 each, or it could be 2,000. Even if it's at 2,000, if you've got gold, you've done really well. It's all relative. So there you go. Let's quickly look at where the markets are this morning. 8:32 a.m. London time. A lot of volatility in gold still. We're at 32.82. Low's been 67. The high's been 33.37. So not concerned, of course. This is short-term moves. Silver's down 18 cents. So it's outperforming gold slightly here. It's at 32.90. The low's been 63. The high's 33.21. The Dow futures is down 56 points. NASDAQ down 26. S&P is only down 8. So markets pretty steady. Stock markets. Currencies as well are not really moving that much. We got pound down 1/10, just below 133. The euro is down 0.15 at 113.46. Dollar has rebounded versus the yen. I think we got down to 140 recently. We're almost back to 144. Dollar's also rebounded versus the Swiss franc. We got down to 80. It's now 83.06. WTI crude oil is unchanged, just below 63. High-grade copper is down 0.4% at 4.87. And the 10-year yield Yeah, that came off a little bit late last week. It's unchanged at 4.265. So I think that's soothing. That will help Mr. Besant. He doesn't want to see it go too high, but he might not have a say in what the markets do, right? That's the markets are much bigger than Besant. That's unless the central banks start printing or doing yield curve control, which is highly possible. So with that, I'm going to wish you all a very good day. Take care. Bye.